One of the most highly regarded collectible car market indicators just set a new all-time high. With a value of 77, the indicator is showing that the market might soon be superheated. As Hagerty puts it themselves, this is an unprecedented score. Experts have even rated this market as the hottest one in nearly a decade. Collectible car sales are at an all-time high, private sales are through the roof, and also auction activity is sky high thanks to the successful online auction platforms. Yet, it's not just the quantities, also collectible car values are at their highest point ever. Though, I don't know about you guys, but I always get a little bit suspicious when things are constantly breaking records. With all of these all-time highs, we might then also be approaching a bubble. Now what hopefully also will be approaching all-time highs is the number of likes for this video. If you enjoyed this video, please support the channel by clicking on the like button down below. Thank you. Hagerty's market rating is not just any market rating. As someone who has a YouTube channel about car values, I read a lot of articles about car prices. Some material is excellent and some is, well, less good. But the Hagerty market rating definitely falls in the first category. In case you don't know Hagerty, they are a niche insurance company for collectible cars and have grown to the largest membership organization for car lovers. Their affinity for numbers is then also reflected in the market index. It's not just based on the average price over time. It's more rounded and a bit more complex. Consequently, it's less intuitive than the average over time, but it's much more reliable as it filters out a lot of noise. Their market rating conveys the classic car or collectible car market performance as a number that can sit between 0 and 100. Now you won't be surprised to find out that the higher the number, the hotter the market. Most of the time, however, it's likely that the score sits between 40 and 60. The scores over time are namely expected to follow something called a bell curve. And this means that, over time, scores are most likely to fluctuate around the mean of 50, while the chances of being higher or lower than 50 decrease symmetrically when you move away from the middle. An additional benefit of this is that the rating moves fluidly in the 40 to 60 range, but becomes more difficult to move at its extremes. If we look at its development over time, we can see that since its inception in 2017, it has never been this high. However, what's especially noteworthy here is the severity of the increase since September 2020. Hagerty even describes it as exponential. The only other time prices increased with this speed was after the financial crisis. But the starting position was completely different back then. The index was below 50. Consequently, we can see that there was a slowdown at the end of 2011 and that it took 3 years for the index to move from a score of 60 to 1 over 70. And this further reinforces the idea that the recent surge is unprecedented. Yet, it's interesting that the driving forces behind the increase are the same. You see, the index is rather smart. It uses the weighted average of 8 different components. And these are in order of importance: the Hagerty price guide editorialized values, auction activity, expert sentiment, Hagerty price guide indices, private sales activity, insured values for the broad market, insured values at the high end, and correlated macroeconomic indicators. All of these indicators are contributing to the rapid increase in the index, but 4 of them are at an all-time high. The first one is the Hagerty price guide. This is a guide in which new prices are calculated every 4 months. Out of this guide, they take the average and median values for the so-called condition 3 cars as input to the metrics. And if you are a subscriber to the channel, I don't need to explain to you that prices increase significantly. So with a high weight for this indicator, it's no surprise that this pushed the market rating up. The second and the third driver for the market rating are the auction activity and the sales activity. The auction activity has the second highest weight in the index and is based on the 1-year moving average of the count of sold cars and the moving average for the median price of cars sold. Interestingly, they point out that auction sales represent less than 5% of the annual sales, but that is extremely valuable due to its high transparency. It's also no surprise that auction activity drove the market rating up. I'm sure many of you have been following the auction prices. Now, when it comes to the private sales activity, they have a unique advantage. As an insurance company, they can request data from their customers and this gives them unique insights. They, for example, know if customers are increasing or decreasing the insured value or when they call for a quote. Concretely, this means that they use a moving average of the private sale price in combination with the percentage of cars that sold for more than what they were insured. They provided a snapshot of the private sales data and, unsurprisingly, also this shows that prices are up, hereby pushing up the market index. Now the final indicator that's at an all-time high and is pushing the market score up is what they call correlated instruments. These instruments consist out of a selection of macroeconomic variables, including the S&P 500, the home price index, the price of gold, and retail sales. What's interesting about this category is that they state that there's no reliable and direct causation between the development in one of the variables and classic car prices. However, they do note that broad economic factors in general are correlated to the collectible car market. We already discussed this before on the channel. Research papers namely show that the correlation between the stock market and the classic car market is relatively low. One paper, for example, found that with 0.34, the correlation was the highest between classic cars and the world index. But if you want to know more about that, then I recommend that you click over here. Now, due to the low correlation, the weight of this category on the market score is low. Nevertheless, many of them were close to all-time highs not too long ago, hereby contributing to the high market score. But we need to keep one thing in mind when we look at all of these indicators and the prices, and that's inflation. With a rate of 7.5%, US inflation is the highest in 40 years, hereby increasing prices for basically everything. However, also corrected for this enormous inflation, collectible car prices are close to their all-time highs. Over here we have the inflation-adjusted Hagerty market index, and also here we can see that prices surged a lot since the end of 2020. True, values are not yet at the all-time highs that we saw in 2015, but they aren't far off, so there's a slight difference compared to the market score that we saw earlier. But the general idea is the same. Values are high. Now, as you might know, this doesn't just go for the collectible cars that are part of these Hagerty indices. We saw new and used cars setting price records month after month during last year. But also the middle segment, the one that I usually discuss on the channel, saw severe increases. 996 Carreras increased with more than 50%, GT3s are up by 40%, and just last week we saw that the mid-engine Ferrari market is exceptionally strong. So to sum it up, all prices are high. And this raises the question, did things get a bit out of hand and is a correction waiting for us? You see, next to all of these price records, there are also plenty of other indicators that are flashing red, hereby showing that these exorbitant price increases might soon be history. US consumer sentiment is, for example, close to an 11-year low. Many supply chains are still disrupted, labor is hard to come by, and like we already discussed, inflation is high. Unsurprisingly, with so many indicators pointing towards a possible correction, there's no shortage on articles and clips predicting the next market crash. But are we in a bubble? Or are these rapid price increases justified? After all, collectible cars are fixed assets, and these type of assets tend to perform well in times of inflation. According to a recent article published by Hagerty, we are most likely not in a bubble stage. But, and this is important, it depends on the market you look at. They reveal that the percentage of cars selling at record prices is similar to the peak in 2015, hereby actually highlighting that we might be in a bubble. Yet, after that peak, only specific markets declined while others remained flat. And applying this type of reasoning to the current price level, they write that older European cars are most likely not in a bubble, while 90s Japanese cars might be. In general though, they mention that auctions get way more attention than before, and this increase in popularity might be here to stay and therefore might justify the higher prices. Moreover, they point out that collectible car prices aren't purely driven by speculators and are therefore less prone to a boom and bust. Yet, history showed us that it can also happen in the collectible car market. In the late 80s and the beginning of the 90s, prices for collectible cars skyrocketed as they were mainly bought for investment purposes, and this was largely driven by the strong Japanese yen. So what's the best thing to do in the current market? Sell, as there might be a collapse, buy because values might increase more, or nothing. Nobody knows for sure what will happen, and no amount of data can give you a certain answer. So that means that we need to think in terms of probabilities. If we do that, we see that the recent price increase and many of the other indicators we talked about are entering an area where they historically don't hang around too long. Therefore, I think it's rather risky to expect that the current price increase will continue at the same pace. It might be more likely that prices will flatten, as the underlying price drivers will go back to more normal levels. We, for example, already saw a flattening of the price trend in the Carrera market. Consequently, if you own a car you're not too fond of, now might be a good moment to sell it. But what if you are on the other side and you're looking to purchase a collectible car? I think that the first question to ask yourself is whether or not you love the car. If no, and you're purely buying it for investment purposes, it might be a risky move. Like we discussed, most indicators are at heightened or extreme values. If you love the car, I think that the next question you should ask yourself is if the current value is also what the car is worth to you, and if it would bother you if the car would lose some money. If you need to stretch yourself and will be checking all the auction results to see if the car didn't lose any value, it might be a risky move. However, if you love the car is trading at a value that you think it's worth, and you're not going to lose sleep over it possibly dropping in value, you might just as well go for it. For all we know, the price increase might even accelerate. And with that, we arrived at the end of this video. Now, if you enjoy this data-driven way of analyzing car markets, but would like to see the analysis for a specific car, head over to my channel as you will find many car market analysis over there. If you can't find the car you're looking for, let me know down below in the comment section for which car you would like to see an analysis. I frequently make videos about cars that are requested in the comment section. Don't forget then to subscribe and to click on the notification bell so you get notified when your requested analysis goes live. As always, thank you for watching and I hope to see you next week for a new video.